Hello, hello. Dan here with G2 Jake, and welcome back to the True Success Podcast for episode 40. 40, that's pretty good, Jake, I think. Today, we're killing a sacred cow. The idea that maxing out your 401k is always the smart move.
What's going on, everyone? Look, maxing out, it sounds great on paper, forced discipline and a tax break, but there's a silent drag that no one talks about. Not saving is not bad. It's the liquidity that's king. In 2026, if your money is locked in a cage until you're 60, you may be 401k rich but cash poor.
Exactly. I call it wealth paralysis, Jake. What's the biggest risk of overfunding the 401k too early?
Well, it really comes down to taxes. So people forget that the 401k is a joint account with the IRS and that they get to decide the tax rates 30 years from now. If you need that cash today for a house, a business, or whatever, you're looking at taxes, a 10% penalty, and a 20% mandatory withholding. You could take out a loan, but that opens up another can of worms and should really only be considered in unique emergency circumstances. You're paying a massive exit fee just to use your own money.
So instead of building a retirement fortress you can't live in, we talk about restylement. That means keeping cash accessible for real life.
Exactly. First homes, emergency funds, starting a side hustle. These are things that actually build a life that you decide. If you tied up every dollar in your 401k, you've traded your current opportunities for a hypothetical future.
All right, let's give folks the tax out roadmap. How do we play this smarter?
Well, the first thing is to build your emergency fortress. Before you give the 401k a dime, make sure your right now is covered. If a $2,000 car repair sends you into credit card debt, your 401k isn't helping you at all. It's just sending you deeper into financial distress.
But step two, Jake, take the free lunch. Get the employer match. That's an instant 100% return. But once you hit that match, stop. Don't just keep pouring water into a bucket with a tax hole in the bottom.
And that brings us to our final step, number three, which is diversify the tax bucket. Put that next dollar into a taxable brokerage, an HSA, or a 529 if you want a tax flexible life so that you have flexibility, not just a future bill owed to the government.
Right, right. Yeah, we've been saying it a long time at WMGNA. The plan informs the investments. Most people aren't just saving for a rocking chair at 65. They're saving for a wedding next year, a business in 5 years, or a legacy. If maxing out means you can't afford your life, it's a pretty bad plan.
And just to be clear, maxing out, it can make sense, but if your foundation is rock solid and your cash flow is a river, then fine, go ahead and stow it away.
Right on, especially if you're in the red zone. 5 years near retirement, restylement, and need to lower that 2026 tax bill. But even then, you have to watch the new Rothification rules on catch up contributions. The IRS just changed the locks on the doors this year.
And saving isn't one size fits all. It's really about balance. Get the match, build your flexibility, save for today and the next 5, 10, 20, 30 years, and so on.
If you're tired of the guesswork and want a plan built on evidence, not just 401k propaganda, hit the subscribe button. We drop new episodes every 2 weeks to help you keep more of what you earn. If you have a coworker who thinks their 401k is a safe haven, do them a favor and send them this episode.
Thanks for tuning in, everyone. If you're ready to see what your wealth is actually capable of when the IRS isn't your primary beneficiary, just reach out because at WMGNA, we figure it out so you don't have to.